Let me start with an interesting fact for you. Between the years 2015 to 21, over $260 billion have come from PE and VC funds to Indian companies. This is Sridhar Ramachandran, and as a PE guy, I have evaluated over 200 pitch documents and rejected 96% of them because they don't deserve it. I would cite a few reasons: poor business model, inefficient working capital management, low margin businesses, tough to exit, poor governance, and so on. Let me give you some pointers as to when you need private equity. Are you in aggressive growth mode? You remember the largest PE deal by Jio, worth 60,000 crores from 8 PE funds including Facebook and KKR. Are you in distress or over leveraged? Piramal Bain PE invested 600 crores into Setco Automotive to turn around the business. Are you in acquisition mode? Eon Partners funded JSW to buy out Monat, Ispat and Energy. Unable to give exit to existing PEs? Promoters often find it difficult to give exit to PE funds after the term is completed. This may be due to market conditions or they don't have resources to buy back. So the only way is to get another PE fund like Carlyle bidding for $3 billion to buy the stake of Barings Asia in Exoter. Do you need pre-IPO funding? PE funds act as anchor investors like BlackRock, Morgan Stanley investing into Nykaa before they went public. Are you burning more cash to grow the business? Flipkart continues to burn more cash and is not profitable yet, but got funding from Canada Pension Fund, SoftBank and others. Fundamentally, your business should be able to generate more returns than your competitors over a defined period, and market valuation can give the upside to the investors. Also, you should not have cobwebs in your balance sheet. Then only PE and VC fund would come in. It is not only PE fund that make money, but the valuation also gives upside to the promoter holding. We must understand that revenue and job growth are much higher in PE-backed companies compared to non-PE backed companies. Also, PE funds would help you to improve the governance standard as they normally bring better boards, improved internal controls and transparency. Traditionally, India's GDP growth had a direct correlation with banking credit growth until 2014, but it has changed for the better. Now, the growth is fueled by private capital, be it in startup or in operating companies. Do you know why? High NPAs at banks forced them to reduce their aggressive credit growth that closed the easy debt funding across sectors. Everyone started chasing investment bankers to get private equity. Some wanted to grow very fast and some wanted to bail out the distressed companies. Has it been easy? I would say not at all. Not everyone gets it because many promoters and companies have not understood the minds of the private equity or VCs, nor did they figure out why they need the private equity. It is a no-brainer that PE and VC funding is a costly affair. Nassim Nicholas Taleb said, private equity has absolutely no reason to exist. The private equity holder all the upside and the banks all the downside. But the truth is, private equity is growing substantially both globally and in India.